Mutually owned organisations such as building societies and cooperatives have always had narrower options when it comes to beefing up their capital, as they cannot issue equity like their listed peers. At the same time, all players in the financial sector are facing tighter regulatory requirements since the 2009 crisis. Yet despite these potential breaks, the mutual sector's share of the mortgage lending market has grown. I'm here with Graham Beale, Chief Executive at Nationwide Building Society, the biggest in the UK, to talk about changes in the sector and whether this rise can continue. Graham, thank you for joining us.
You're welcome.
So, can you run down a few of the ways an organisation like Nationwide can currently raise capital?
Okay, well, the most traditional source of capital for all building societies is retained earnings, so the profit after tax, and that represents the majority of the capital that's there today. Historically, we've had an instrument called Pibs, which is permanent interest-bearing shares, which counted as a type of capital, but they don't count as core tier 1. So in the new regime, we've been working with the regulators to design a new instrument, and we've come up with something called Core Capital Deferred Share, CCDS for short, and that, it's not been issued yet, but that will ultimately replace Pibs so that organisations can top up the capital or respond to needs for additional capital by using that new instrument.
So what actually are Pibs in the comparison to CCDS? I mean, they're a kind of hybrid, aren't they?
Yeah, a Pibs, the thing about a Pibs was it's subordinate on the balance sheet, so it will absorb losses in the event of insolvency. But on a day-to-day basis, it would just carry an interest coupon, and it would be paid as a fixed, typically as a fixed interest coupon. You can get floating as well, but it was really has more the characteristics of debt than it would do of capital today. CCDS are designed to take losses on an ongoing basis. So if it basically, rather than having a fixed coupon, it will have a floating coupon. There will be a dividend distribution policy which will be determined by the board. And in the event that an organisation is not successful, it suffers losses or whatever, those losses can be passed on to the note holders. But to protect our ordinary membership, who ultimately are the owners of building societies because of our mutual status, the coupon on the CCDS is capped, so you can't over-distribute value, and that's the protection that is given to the full membership of these societies.
So what's the context behind this? Because the impetus for this change came from Europe, didn't it, in the new CRD4 legislation?
It did. It's really trying to, well, it's anticipating CRD4, it's trying to come up with something which will be sustainable as a form of capital going forward. It is new, and the big issue for building societies is their mutual status, because we are owned by our members who are also our customers. So we didn't want to compromise their position in terms of their ownership structure, but we do need to have access to capital as much for strategic reasons as anything else.
What kind of timescale would we be looking at for CCDS? I mean, within the next year or 18 months potentially?
Well, it's taken about 2 years in terms of just negotiating with all the different regulators, including with Europe. And I have to say that the FSA, as was, were very supportive and helpful in this process. We've completed the design, so it's good to go. I think the next thing is to test investor appetite. We're hoping to do that in the near future. I would say within the next 12 months is a realistic time frame. Nothing big, it's just really an issue to prove that there is an appetite and that the thing works, because it's one thing to design it, it's another thing to actually issue it to real investors. So that's the next step to prove that it's there. Okay. So I would like to think that will be done within the next year.
So very much a case of test issuance. And on the question of mortgage lending, mutuals, I mean, growing their market share, you know, what's driving that? Is it a question of demand or banks retrenching? What's going on there?
I think it's a bit of both. I think the market is more buoyant than it's been for a while. I think it's also the case that some of the banks are repositioning their balance sheet, they're delevering, they're managing their own capital by actually taking assets off the balance sheet, which has created a nice opening for the mutual sector. This is what mutuals do. Mutuals are here to look after savers and to lend to people who want to buy their homes. So I think it's great that the sector, and it's very much led by the example that we've set, we've really tried hard to increase lending, and particularly to focus on first-time buyers. So for the sector as a whole, about 1 in 3 of the loans goes to first-time buyers, and for Nationwide, we've more or less doubled the lending to first-time buyers this year compared with the previous year. And that's good, because that's what mutuals are about.
Graham Beale, thank you very much for joining us.